Oh no.
Cool. Hey everyone. Welcome to our webinar today. My name's Stacey. I'm the Sales and Marketing Coordinator here at Relab. I've got my guests up on stage, Ed and Andrew from Opes Partners. They've got a pretty cool presentation today all around the government's recent tax changes and how you can respond as a real estate agent, investor, developer. So just for the audience, please feel free to and let us know who you are and where you're from. It's nice to know who we're talking to. And the webinar will roughly go for 45 minutes. There'll be question time, so feel free to put in your questions, and Ed and Andrew can get to that whenever they want or at the end. And our Relab team will be in the chat just to monitor any questions about the webinar. And you will receive a recording later on in the day. So in case you miss anything or have to pop off, you'll get that in your email address. Cool. So I will pass over to Ed and Andrew now for their presentation.
Fantastic. And Stacey, thanks so much for having us here today at this Relab webinar. Really excited to be here. Now, before we get started, I need to say, Andrew, you need to stop rustling your papers because it's coming through. He's terrible, isn't he? Now, we've got a banger for you guys today, all about the government's tax changes. Now, we've specifically geared this around how it's going to impact property investors. And what we want you to take away as real estate agents and developers is how you can start advising the property investors that you're working with. So if you're a developer building for investors, this is going to give you a really good sense of the choices that property investors have. So this is going to be really valuable. Now, as we go along, please do put your questions into the chat and into the question section because we will get to those at the end. Now, let's run into this. I'm going to share my screen and we're going to start talking about this. Can you see that, Andrew?
No. Oh, yes.
You can't see it. You can.
I can see
Perfect.
it now. I can see it now.
So we're talking about how the government's tax changes are going to impact property investors. Now, you might be wondering, well, why am I listening to these two attractive gentlemen? Well, first of all, this is Andrew. He is an authorized financial advisor, or just financial advisor these days is what it's called. He is the host of the Property Academy podcast, New Zealand's #1 business podcast with over 800 episodes released. He is a prolific property investor and what we're calling Rupert Murdoch 2.0. Now, Andrew, just tell everybody why we've bothered writing that.
So in the original lockdown, the one that you Aucklanders won't even remember now, I think that you've taken your stride. We purchased a magazine, Juno Investment Magazine, because they were going to close the doors, and we thought we can't have that. It's a great magazine, so we bought that. We've now bought New Zealand Property Investor Magazine, and we're
Is Andrew still there, or is it me who has lost internet?
I can't hear him either.
Oh, well, I'm going to take over then, and we'll just see what happens when Andrew comes back online. Sounds like he's coming on there, but we call him Rupert Murdoch 2.0 because of both the ownership of New Zealand's two main investing magazines. Now, in terms of me, my name is Ed McKnight. I'm an economist at Opes Partners, also co-host that Property Academy podcast with Andrew. I'm a property investor myself and a prolific data nerd. Now, we're specifically talking about the government's tax changes as they relate to property investors, and the reason we're talking about it is that they are hefty. So the discussion document, which came out in about July this year, was 143 pages long. The initial legislation has been released, and again, it's over 100 pages long. So what we want to do in this short session today is take you through what you need to know, and most importantly, what your clients, if you're a real estate agent, or your purchasers, if you're a developer, can do in order to respond to these tax changes. So there are three things we're going to cover: the impact of the changes, the opportunities that are presented for property investors, and then if you've got an existing portfolio, or if an investor has an existing portfolio, what are the things that they can do to respond? Andrew, take us through the impact of these tax changes and the difference between how your tax was calculated before compared to how it will be now.
Okay, just confirming you can hear me now and see me now.
Absolutely.
Okay. All right. So we've done a bit of a case study. Let's say you've got rent of $675 a week, so 35 grand a year, and you've got operating costs, your rates, insurance, maintenance, all those kind of things of 10K, and your interest costs on a mortgage at 3.5% of $29,000. So the vast majority of your costs are your interest, which is pretty normal for most investors. Your profit on that scenario is negative $4,000, so you're making a loss. So your tax is zero. All very easy. Everyone understands that. Your cash flow per week is negative $77. So negatively geared by $77 a week. Everyone's happy. You can afford to hold that property. Everyone, no issues. Now, the way that the government are looking at it now is they're moving your interest to below the profit line. So what that means is, Ed, there we go. Your rent minus your operating costs will equal your profit. I know it's not your real profit, but that's the profit that the IRD are going to consider taxable. So in this case, it's $25,000. Now, if you're paying 33 cents in the dollar there, that's $8,250 you're going to pay in tax. So you were paying nothing before, now you've got $8,250. Your interest costs, of course, are still going to come out. That means your actual cost per week is negative cash flow $236 a week. So you've gone from $77 to negative $236 a week, $159 worse off per week from a cash flow perspective, which is massive.
And so let's just compare that as well between that before and after, Andrew.
So your tax before was nothing because you were making a loss. Your tax now, even though you're making that same cash flow loss, is $8,250. So you've got to pay that over and above your cash. So your cash flow goes from $77 a week negative to negative $236 a week. So as I said before, massive increase in the amount of contribution you have to make towards a rental property.
And I think the key thing to get across is while we've blasted through these numbers really, really quickly, this is the slide that you really want to think about. The first thing to note is that those interest costs are being moved below the profit line, and it's not actually necessarily an increase in the tax rate. It's not an increase in the tax rate at all. It is a change in how profit is calculated, resulting in more tax being paid. And the key thing here, or the reason that a lot of people, I don't think have got their heads fully around what these interest deductibility tax changes mean, is because they are quite complicated to explain. That it's not actually an increase in tax, it's a change in how the profit's calculated.
We've probably been so lucky to have such low interest rates for the last wee while that it hasn't made as much of an impact. But as those interest rates increase, this is going to significantly affect your ability to hold on to any properties that you already have as rental properties.
Well, actually, that's a good point, Andrew, to then ask, well, how can people estimate really simply the impact of these tax changes?
So basically your interest rate, if you want to work out what your cash flow is going to look like, you need to multiply your interest rate by 150%. So that extra 50% will accommodate that 33 cents in the dollar tax rate. Now, if you're on the 39-cent tax rate, it's even higher than that.
Absolutely. And let's just compare as well the difference between two cash flows. Just explain what we've got here, Andrew, and the difference it makes.
So, this is taken from our return on investment calculator. So this shows the cash flow over a 15-year period. The left-hand side shows you your positive years of cash flow, and then you'll see some negative years in there as well. That's when we're allowing for interest rates to go up. Basically now, if you see the second one, and actually just tell me, is this based on a phase out of an existing property purchased prior to the 27th of March or after?
This is a phase out.
Phase out. So this what that means is if you bought an investment property and you already own it prior to the 27th of March, and the IRD consider that old now, i.e. code of compliance came out after 27th of March 2020, then before that, then what that means is your interest deductibility is phased out over a 4-year period. If you buy one today, an old property today, there's no deductibility. So basically, the entire 15 years would be negatively geared. That'd all be red lines. So you're paying an extra $100,000 in tax than you were prior to the government's changes over that 15-year period.
So look, the impact is pretty large. It's pretty scary. It's enough to make you think, why are we investing in property again? But what I need you to remember is that there are opportunities here, and there are a lot of opportunities. There are some places in property investment that don't make sense anymore, and we'll talk about what those are, but there are opportunities. So let's go through these and talk about the 3 critical opportunities that you as a developer or you as a real estate agent need to be aware of. And the obvious one is new builds. So new builds are exempt from the changes. And what I just want to go through today are 3 key things that you need to know about new builds, because there was initial stuff that came out in the consultation document, the discussion document, where the government said, we're thinking of doing this. Now that got widely reported, but when the draft legislation came out, some things had changed. And so some stuff that you might have read in the New Zealand Herald or on stuff.co.nz 3 months ago, that may no longer be relevant. So I want to take you through the basics of the 3 things you need to know about a new build. And the first thing is the cutoff date for what's considered a new build has actually been moved back since the initial discussion document came out. So in the initial discussion document, what they said was 27th of March 2021, if the CCC, if the code compliance came out on 27th of March or afterwards, it's a new build. Any time before that, even if it was the day after they announced the policy, that wouldn't be considered a new build. Now, the really cool thing in the legislation is that that has been moved back by a year. So it's been moved back from 27th of March 2021 back to 27th of March 2020. Now, you might be thinking, Ed, that's very technical. Why are you telling me this? Well, it has a big, big impact. And that impact is going to, people who are going to feel that impact are about 550 of the investors that we've specifically worked with who have bought new builds. And I'm sure if you're a real estate agent watching this, there are going to be some people who potentially purchased through you who didn't come under the previous definition, but will under the new definition. We're estimating that those 550 investors that we've worked with are going to pay about $37 million less in tax over the next 15 years by that small change in what the cutoff date is. So while you think, oh, it's just a change in the year, it's massive in terms of its impact if people have been purchasing new builds. The second thing that I want to let you know about is that this tax incentive lasts for 20 years and is transferable. Now, this is really important. So let me just tell you what this means. Let's say code compliance comes out on 2022. That exemption, the ability to claim those lower taxes than would otherwise be the case, lasts for a total of 20 years before converting over to an existing property. Now, in the discussion document that came out, they didn't know what it was going to be. They didn't know whether it was going to be 5 years, 10 years, 35 years indefinitely. Now, a rule has been put in place. It's going to be 20 years. Even if you were to sell that property 10 years in, hey, the exemption still carries on for the last 10 years. Now, that's important for you real estate agents who are thinking of selling a property that was bought as new, because that means that you can still sell that property to an investor or some other purchaser who would otherwise be caught under the interest deductibility rules. It also is really good.
Sorry, just one thing to add there. Just one thing that I was talking to a real estate agent about this week is the definition of new is different from an IRD tax standpoint than it is from the bank. So when a bank takes on that property, it is considered existing, and so you need to have a 40% deposit. But from a tax perspective, it's still got that interest deductibility. So they're 2 different things, just something to be aware of.
That is a very good point, Andrew. And the other place where this can be really beneficial is that, let's say a first home buyer purchased a property, code compliance comes out 2022. If they move into it for a year and then decide to turn it into a rental, that tax incentive is still there. So in the initial documents, they were thinking, well, if somebody lives in an owner-occupier, maybe we take off that exemption. Maybe we take off that tax incentive. No, it sticks with the property for 20 years. So I just want to point out what the rules actually are today, since there were a whole heap of different potential rules or things up for discussion that have now actually been decided. So what do we know? First of all, the cutoff date has been moved back. Second thing, it lasts for 20 years. And the last thing that I just want to mention as well is that you can add a new build to an old property. And we'll talk more about this in the future opportunities, but I just want to give you an example. Let's say that you've got a house on the front of a section, and you've got somebody who decides to build a minor dwelling on the back of that property. Well, any interest associated with the minor dwelling will be tax deductible, but any interest costs associated with the front house will not be considered tax deductible after the phase out. So there is an opportunity here. Let's say that you're somebody who wants to help homeowners or property investors build minor dwellings on the back of their properties. This is a big opportunity for you, because you can encourage people to build minor dwellings on the back of their properties in order to increase the cash flow and pay for that extra tax, assuming that the numbers all work out that way. So there are 3 really good opportunities there, specifically around new builds. But that doesn't mean that new builds have all the opportunity, even though they're the ones that have got the major media attention. So Andrew, talk to us a bit about 5 other exemptions from these new scary tax rules.
Sure. So the first one, drum roll please, is new build conversion. So say you've got a house at the moment where it's a large 4-bedroom house, and I've seen this quite a lot, particularly for old investors where they really want to get as much rent as possible. What they'll do is they'll divide the property into 2-bedroom units, for example. Now, each property has to have its own facilities, but so long as you can still get 2 dwellings out of it, that property is now considered new. A new code of compliance has to issue on it, but that's how you then create a 4-bedroom house into 2-bedroom dwellings with tax deductibility. The second one is relocatables, because again, a big part of this is trying to encourage more stock onto the market, hence why new are exempt. So if you can find a property that's in the middle of nowhere, it's going to be demoed anyway, and you can relocate that, then all of a sudden that's deductible as well. Third is student accommodation and boarding houses. So they're exempt because they kind of fall within the commercial arena as well. So if you've got a student accommodation and boarding house, Ed, actually just on that note, the second discussion document didn't have much about this. Is that right?
There wasn't a clear definition of what boarding houses are, unfortunately.
Yeah.
But what I do know, particularly down in Christchurch, since this legislation has come into place, the market for boarding houses, or since it was announced, I should say, the market for boarding houses has taken off. And there are some investment specialist real estate agents down in Christchurch, which is a market that we're quite familiar with, who are doing very well selling these sorts of properties, given that they have a tax incentive around them as well.
And it's just asked the question, what are the exemptions for new builds? Can you deduct interest from interest? Yes, the interest for your loan is deductible on a new property. It's not for an existing property. And exemption number 4 is for hotels. Again, I guess this falls under commercial a little bit more than it would a normal residential property. So that too is exempt. You can claim the interest on any loan that you've got for a hotel room. Next one, final one, is if you rent your property to the likes of Kāinga Ora or community housing, so Auckland City Mission or Salvation Army, if you're providing to that emergency housing stock that we need so desperately, 25,000 properties are in need through these emergency housing providers, then you get interest deductibility as well. So if you own a property right now and you say, hey, look, I'm happy to give this to the Salvation Army to rent out as emergency housing, you can claim the interest on the loan.
And so those 5 key exemptions or 5 key opportunities, again, for you to be advising your investors on, obviously new is given, but then we also talked about things like your hotels, your social housing, relocatables, dividing up properties, and then student accommodation and boarding houses. So this just gives you a bit of a sense, even though we've run through this in record time, there are opportunities out there. That is not the end of property investment as we know it, but those property investment dollars are likely to go into very specific and new areas in order to be able to make sure that property investors aren't paying that additional tax out of their own back pockets. The last thing that I want to talk to you
Yes.
as well about those opportunities is not just the new builds, it's not just the exemptions, but also renovations. So there is a fear that this is the end as we know it for existing investment properties, people purchasing those existing rental properties. But if you're able to purchase a property and significantly renovate it to the point where its cash flow, the rent that it generates, has dramatically increased compared to your mortgage, then you will still be okay. You can still be cash flow positive as a property investor, but you really need to, what we call cash flow hack those investment properties to get the rent up. So if you're a real estate agent watching this and you're thinking, well, I've got a rundown property that really no homeowner's got who's going to do it up, that can still be a valid path.
Oh, we lost Ed. We lost you there for a second there, buddy, but you're back again.
But there are some specific things that those investors can do in order to get that rent up. And I want to take you through now our top 6 steps, our 6 cash flow hacking steps in order to be able to get that rent up. The first one is to
you just
add
need
an
to share your screen again, buddy.
Oh, great. Perfect. Thank you for letting me know that, Andrew.
Sorry, guys, technical difficulties, and it's so much harder with Ed's still in Auckland lockdown. This is your day of freedom, though, isn't it, buddy?
It's Freedom Day. I feel like, is it Mel Gibson on Braveheart where he goes, freedom? Is that right? You're into movies, Andrew.
Oh, I've never seen Braveheart. It's too mad.
Oh, mate.
I still love, actually.
That's terrible. You'll be bawling your eyes out at it. It's a banger. Now, the 6 principles of cash flow hacking so you can get that rent up. First thing is adding an extra bedroom. Now, if you want to know how to do this, either check out our Instagram. We are at Opes_Partners, because 2 days ago we released a post specifically about how to add extra bedrooms to properties, and also how to identify the floor space needed in order to be able to say, does this property have enough space in order to add this in? And I'm sure Stacey will be able to tell you as well, there's probably a feature on Relab that teaches you how to do that when you're doing due diligence as well. The second thing is to assess your rental options. And what I mean by that is, could you start using a room-by-room rental option or a boarding house model in order to get the rent up? Because if you turn your property into a multi-income property, then you are more likely to achieve a higher rent compared to if it's a single-income property. Kitchens and bathrooms as well, great place to target that spending, as well as updating fittings like light shades, door handles, the front step, all of those good things. And then doing an internal paint refresh as well, because that tenants are really going to value more so than an external paint job. That's where we'd really target our spending, as well as bringing up the carpet, trying to revitalize it, whether by replacing it or by cleaning it and giving it a refresh as well. So really what we've talked about here is I've tried to give you as many ideas as possible of things that you can do or things you can advise your clients of, whether you're a real estate agent or a developer, in order to start to combat these changes. For developers, it could be encouraging investors to build minor dwellings on the back section. For you real estate agents, it could be encouraging these investors to renovate these properties in specific ways, or to start targeting investors' spend into specific exempt properties, like your boarding houses, like your hotel rooms, like your student accommodation. So I know through it quickly, but you might want to rewatch it in order to be able to get down all of those opportunities as well, because there are some opportunities there. Now, a big question, Andrew, that a lot of people are probably asking is, well, what about my clients who have an existing portfolio? What do they do with their existing properties?
Yeah, and this is where we've introduced, we've set up a thing called the 5 R's, and I think this is really important, even before the government's changes, to always be disciplined enough to go through and do this with your portfolio. So our number 1 is review. We're big on making sure that your rental property or your investment is right in 5 years as it was the day that you bought it, because things change. You might have bought in a market that maybe isn't performing the way you wanted. Queenstown would be an example of somewhere. And the way that we think you should review your properties is really get down to the numbers. And so we've created a thing called a return on investment calculator, which we call the holy grail of spreadsheets, where you can download this for free at opespartners.co.nz/ROI. The spreadsheet, you enter in all your details of up to 3 properties, and you compare them, and it will give you a return on investment. It will give you the cash flow. It will show you what the numbers look like moving forward in 15 years. You can put in higher interest rates, inflation, rental inflation, all of your costs, and it will give you your cash flow. But then it helps figure out, okay, if I need to make a contribution, what does it have to look like over that period of time? So download that and have a play around. It's an awesome tool.
The second you've beaten me to it. Number 2 is to increase your rent. So right across the country, rents are increasing massively. So I'm going to put in front of you the August to August data from the Trade Me Rental Index over the last 12 months. So you can see Taranaki rents, the median rent is up 19%. Canterbury, 11.5% almost. Wellington, 9%. As a country, almost 8%. So rents are on the up and up. So big thing is, if you haven't increased your rent in a while, make sure you are checking that rent. What is the market level for your investment properties? Because what you want to do is continually bring that property up to the market level, so that when you're taxed more for your existing property, that you're sharing that with your tenants, so that you're not just the one who's being hit in the back pocket there. What's our number 3, Andrew?
Our number 3 is restructure. Now, in the new legislation, there are a few golden nuggets, and one of them is that you can transfer properties from entity to entity without affecting your bright line or resetting your bright line. So what that might mean is that you talk to your accountant. Great example is your property's in your name at the moment. You're on 39% tax rate. You could actually look at transferring that into a trust and reducing that tax rate down to 33%. So just one example. You need to get tax advice before you go doing this, and legal advice potentially, but just an idea. And that's a really good golden nugget. It is a silver lining with these new tax changes.
Our number 4, coming back to that, is renovate. Now, we've already talked about what that means, but using those 6 key cash flow hacking steps in order to increase that rent, increase your revenue, and so that you're not being hit in the back pocket for those taxes. But if you've been through these 4 R's with your existing properties, whether for your clients or whether for yourself, because everybody on this call is probably an investor as well, or looking to become an investor. If you've reviewed that property, you've looked at your rent, you've restructured your tax situation, you've renovated it. If none of that works, that's where we come into our number 5. Andrew, what is it?
The final R is recycle. Now, I do a lot of this personally, and have been doing a lot of this personally, and I do a lot when I'm working with investors. And so this is where, if you've got a property at the moment and it's an existing property, an old property, then you might have some equity in that you can take out and put into other properties that are tax exempt. So again, those social housing, the new builds, relocatables. And I think we've got some numbers around that, Ed. So say you've got an existing property worth 1.05 mil, 600k debt, 450 worth of equity. If you sell that property and pay 50 grand worth of sales costs, that leaves you with 400,000, which is enough for 2 deposits on $1 million properties if they're new build, because you only need a 20% deposit. So you put that into 2 new builds. Now you've got 2 properties going up potentially at 6% if they're in Auckland, rather than 1 property going up at 6%. And from a cash flow perspective, it would be highly likely that this would be a far better return on investment on just one of those properties than both of those properties compared together, rather than just the 1 property.
Perfect. And so again, those 5 R's again: review, rent, restructure, renovate, and then recycle as well. This is the way to review your existing properties to see whether they still make sense to hold. So look, we're coming to the end of our half-hour session before we jump into the questions. And this has been a quick run through of, first of all, the impact of those tax changes. And they are massive, they're hefty, and it is going to hurt a lot of investors once they are fully implemented. But we've also talked about the opportunities. What are some things you can do in order to put yourself in a really good cash flow or financial position? You know, we've talked about new builds, we've talked about the exemptions, we've talked about ways to renovate, and we've also talked about the way to review your existing portfolio. Now, just before we jump into those questions, we always get asked at this part of this webinar is, what do you guys even do? And so I just want to spend 2 minutes taking you through what we actually do at Opes, and who are these two guys talking at me for the last half an hour. Just so you know, we here at Opes Partners, we are what we call property partners. And what that essentially means is we work with property investors from around the country in order to do 3 things. Because here's the thing. It's really tough to be a property investor. You've got to go get the knowledge, you've got to go figure it all out. And so what we want to do is help people to get the guts to go ahead and give property investment a go. And we do that in 3 ways. We help them, first of all, plan out their property portfolios. We then go and find new builds. We go and pick properties that fit within their plan. And then we also dig into the details, confirm that that is the right property for them, and they want to go through due diligence. And the really cool thing, just so you know, because this is the question in everybody's mind, is that we don't actually charge for that service because it's completely complimentary. And the way that works is when we secure an investor deciding, yes, I want to purchase a property, then we get paid a fee from the developer. So if there are any developers on this call who want to find investors for their properties, then please do hit us up. Or if you are interested in coming in and seeing us for a portfolio planning session, that'd be really cool too. I will just say that if you did want to come in for a portfolio planning session, it's pretty cool. It's where we use a piece of software called My Wealth Plan, which you can see here, in order to plan out that property portfolio for those investors. And what I will do actually, Andrew, just while I'm here, and I think I've got the capability of doing this, is I will just allow people, I'll put something across everybody's screen just in case they want to come in and see us. And
while you're doing that, Bing's asked, is a 40% deposit for investing in new build rather than 20%? No. If you buy a new build, Bing, so long as the property is brand new, direct from the developer, you only need a 20% deposit from the bank side of things. Usually it's 10% if it's off plans, and then the other 10% at completion, 80% loan from the bank. That money can come from other assets, so that's quite normal for people to borrow 100%, but 20% reliance on your house. If you buy an existing property, you need to have a 40% deposit. Did we answer Anna's question above? I think I did, but let me just double check. Anna, where are you? Question just about exemptions. So yeah, so the interest for a new build is tax deductible. The interest on an old property is not.
Perfect. Fantastic. Now, I've just popped that across everybody's screens. If you want to come and see us, click that wee button, scroll down to the form, pop your details in, and we'll be in touch in order to do that. And it'd be great to work with you. Now, let's dive into the questions, Andrew. But just before we do that, I do just want to say, if you want to learn more about property, or you want to dig into more of what we talked about today, there are a couple of key things you can do. First of all, start listening to the Property Academy podcast, because every single day, we release a brand new 15-minute episode to teach you something new about property investment here in New Zealand. A lot of real estate agents message me, say they get a lot of value out of this. Episode 813 went live this morning. Also, subscribe to our YouTube channel. Every Wednesday, we release a new video on there. You can just Google Opes Partners YouTube. It's the first thing that comes up. And then follow us on Instagram. And I see that somebody's popped the link in there into the chat. So you've got the ability to do that. We are at _partners. But look, let's dive into questions for the last 11 minutes and just say, well, what else to know? We're going to be around here answering those questions.
So Anna's asked, how long do you have to own a new build to avoid capital gains? To avoid the bright line, Anna, you have to own it for 5 years. So that's another thing that the government have decided to be a bit softer on. So the bright line of 5 years still applies if your building is new. If it's an existing property, it's now 10 years, as you probably know. Knight's asked the definition of a new build. So the way that Ed, you answer that one.
Oh, the definition of a new build is based on when the Code of Compliance was released. So if Code of Compliance was from 27th of March 2020 or after, that is going to be considered a new build. Is it per the title? It's based on the Code Compliance coming out. Now, Louisa's got a great question, which is, if I have a holiday home and decide to rent it out, does that reset the Brightline? No, because Brightline is based on when you purchased that property. Now, because it is not your main home, that means that you do not have the main home exemption. So if you purchase an existing holiday home right now, that's going to have a 10-year Brightline test. So if you sell it before that, any capital gains, you will start to pay tax on those gains. If it's your own home, of course, you don't pay it because there's an exemption for your own home. What's interesting in terms of your holiday home is that some people do get to claim interest deductibility, or had in the past, I should say, because it was considered, because if you rented that property out, but under the new rules, it's an existing property, and so those interest costs, you won't have that deductibility.
And Louise has also asked what happens if it's a new build. So if it's a new build, then it falls under the new build definition. The interest will still be deductible. And you know, are there any rules around how long you have to have rented it out, how many days you have to rent that out for? Because that's something that I haven't come across yet. Yeah.
Yes, there are. I can't remember it off the top of my head, but there are set guidelines from the IRD, which you can Google, that says how many nights you've got to rent it out for.
Yes.
It's quite a few nights.
Because of course, Louise, they will not be wanting you to rent it out for one night a year and then claim all the interest on it. So there'll be prescribed amounts on that to make sure that it is a genuine holiday home that's rented out probably the majority of the time. Any other questions? Ed, we've bashed through them.
Well, I've got a question.
Maybe we do talk too quickly. Yeah. Okay.
Well, actually, while we're here, let me just find something.
Oh God, where's he gone?
No, I'm back. Just before, right at the start, we talked about our magazines, and I do just want to say, this magazine, Informed Investor Magazine, is such a banger. Go to your local Paper Plus and buy this, because it's just amazing. I want to show you some of it because it's just the most beautiful investment magazine you've ever seen in your life. Like, look how beautiful this is. This should be like how Women's Day is designed, not some investment magazine. It's
I would
honestly,
just say, Ed, we have to give Ed a little bit of just take everything he says with a grain of salt at the moment, because he's been locked in his house without me to tell him how to be normal for the last 3 months now. If anyone wants a copy of that, I'll give away 10 copies. So if you email andrew.nicol@opespartners.co.nz and just put Informed Investor, give me your address. For the first 10 people, I'll send out a copy. And
also go down to your local gas station and pick Property Investor magazine, because this is a banger. Honestly, we've just bought this, and our first issue of this under our ownership has just gone to print, and it's just a beautiful mag.
This is just like a media thing for us, the Property Academy podcast.
No, so honestly, it's just, I love this mag. It will give you so many ideas about things to invest in. You're going to be walking away saying, I need to invest in shares. I need to set up a stake account and a hatch account. I'm going to start investing in commercial property. It's a really beautiful mag. It's just, honestly, Christmas presents for the family. It's a beautiful thing. And crypto, Louise, you are right. There's actually an article in here about crypto, which I actually think is the biggest scam. I wish I'd come up with it, because God, that's the way to make some coin. Not personalized financial advice, general in nature.
I'm just going to have Vanessa get a NDA from everyone in the room as well.
Ed's advice only, not. Have you ever had a webinar like this at Relab before?
No, I can't say we have. But that's everything.
Fantastic. Well, look, because we don't have any more questions, we're going to wrap that up there. I'm going to hand it back to our good friend over here, Stacey, to wrap this up for us.
Cool. So thank you everyone for joining us, and thank you Ed and Andrew for coming on. I did get some messages about people struggling to hear on phones. So just remember you will be emailed a copy of the webinar afterwards, and it will be on our socials and everything. So you can go rewatch if there were any issues there. And yeah, don't forget you can do your high-level due diligence on Relab. We've got our subdivision calculator, our Relab planning report that just went live last week. So go check that out. I think this will be great in conjunction with what the guys at Opes Partners do. Yeah, so thanks everyone, and I will wrap that up there.
So, thanks, guys. Thanks for having us.
Bye now. Bye now.